All right, welcome back, focused learners, to today's explainer. We've got a fantastic daily brief lined up for you today, packed with level-headed, strictly data-backed insights on our current financial conditions. Look, if you've been watching the markets lately, you know there is a ton of noise out there. I'm talking panic, wild speculation, and dramatic headlines practically everywhere you look. But today, we are going to completely cut through all that noise. We're putting the emotion aside and we're looking purely at the macroeconomic theory, the hidden mechanics of the market, and the undeniable metrics that tell us what's really going on behind the scenes. So grab your notebook, because we've got some incredibly fascinating ground to cover together.
Here's our stabilizing roadmap for today's explainer. 1. The market bubble myth. 2. Liquidity, gold, and Bitcoin. 3. Real S&P 500 value. 4. Sector rotation in action. 5. The fearless investor metric. And 6. Strategy for the future. Let's get right into it.
Kicking things off with Section 1, the market bubble myth. Are we about to pop?
Okay, let's just dive straight in and address the massive elephant in the room regarding current market sentiment. It's literally the word on everyone's lips right now, and it's driving a lot of retail investors into an absolute state of anxiety. Are we in a speculative bubble? Lots of prestigious analysts and commentators are ringing the alarm bells as we speak, claiming that the financial markets are bloated, completely detached from reality, and ready to pop at any second. But when we actually sit down and look at the real mechanics of market tops, the data tells a vastly different story.
See, the popular myth out there is that high valuations and elevated corporate multipliers, things like a sky-high price-to-earnings ratio, automatically cause a bubble to burst. But historically and mechanically, that's simply not true. High multiples do not pop bubbles on their own. So what actually causes a massive market top and crash? Well, the answer is central banks. A bubble bursts when central banks actively withdraw liquidity from the financial system. That is the objective reality we actually need to be monitoring.
Moving right along to Section 2, liquidity, gold, and Bitcoin, the macro reality.
To understand exactly how this liquidity dynamic works in real time, we just need to look at a macroeconomic chain reaction that is happening right this second. You might have noticed the prices of gold and Bitcoin dropping recently. Well, why is that? It's because these assets are highly sensitive to global liquidity. What actually happened was step 1, the Central Bank of China stepped in and withdrew liquidity from their system to cool down economic activity and reduce their overall oil consumption. Step 2, this withdrawal immediately triggered the drop in gold and Bitcoin, but here is the critical pivot for step 3. China has now started injecting liquidity back into the system. And step 4, because these assets are in a corrective phase right now, this fresh wave of liquidity sets the perfect stage for them to deploy an upward impulse and resume their bullish trend.
Which brings us to Section 3, real S&P 500 value, or the micro reality.
So we know global liquidity is returning to places like China, but what about the United States? What's absolutely fascinating here is this single number, 3%. Right now, hyperscalers, those massive tech giants driving cloud computing and artificial intelligence, are investing an astounding 3% of the entire U.S. gross domestic product into AI infrastructure. They are spending on this build-out like there is literally no tomorrow. So, far from signaling some impending recession, this massive capital expenditure is actively accelerating the U.S. economy.
And the private sector isn't doing this in a vacuum. You've got to combine that huge AI infrastructure spending with the fact that the U.S. public deficit is running at around 6.5%. So the public sector is also spending heavily. With these twin engines of massive private investment and heavy government spending firing at the same time, the most probable scenario is actually economic acceleration. In fact, some projections suggest the U.S. economy could approach a 4% GDP growth pace by the year 2027. Now think about it. If the economy accelerates like that, corporate profits for the S&P 500 are naturally going to rise.
Let's translate those big growth expectations into some standard valuation metrics. If we look at the estimated earnings for the S&P 500 by the end of 2026, the expected forward price-to-earnings ratio is roughly 19. When you compare a PER of 19 against a U.S. bond yield that's sitting around 4.5%, stocks are not just fairly valued, an objective analyst might even argue they're cheap. This completely disarms that whole speculative bubble fear that's been going around.
All right, on to Section 4, sector rotation in action. Let's look at the hidden mechanics. And this brilliantly illustrates what's going on beneath the surface of the major indices. Recently, you probably saw the tech-heavy NASDAQ and the standard S&P 500 stall out. But why? Well, it's because the top 100 momentum stocks, the exact ones that led that massive rally from March to June, just needed to take a breather. You can clearly see this by looking at a momentum ETF like SPMO, which has entered a totally logical, completely normal corrective phase after surging nearly 50%.
But look at the RSB, the equal weight S&P 500 ETF. This one treats all 500 companies equally, right? And it is in a clear uptrend, hitting all-time highs. The broader market isn't crashing at all. The leadership is just changing hands.
This is exactly what we call a healthy sector rotation. The money isn't leaving the market, it's just moving from the AI and semiconductor stocks that ran way too hot and rotating into sectors that were lagging behind. Right now, we're seeing massive surges in biotechnology, pharmaceuticals, with companies like Moderna experiencing some really significant breakouts, and the insurance sector. The market is broadening out, and honestly, that is exactly what you want to see in a sustained bull run.
Next up is Section 5. The Fearless Investor Metric, our secret metric.
So you might be wondering, how do we actually know for sure that this is just a normal rotation and not the start of a massive market top? Well, we use advanced fearless metrics to stay grounded when everyone else is out there panicking. The first tool in our belt is the VIX index. Simply put, this measures the 30-day implied volatility expected by participants in the S&P 500 options market. Usually, when the VIX spikes upward, it's heavily associated with sharp stock market declines. But right now, the VIX is sitting at absolute minimum levels. A low and stable VIX strongly indicates that the overall market uptrend remains totally intact.
Our second tool is a little bit more advanced, implied correlation. Now, don't let the technical terms scare you. This metric simply tells us if the stocks within the S&P 500 are moving synchronized together, which would mean high correlation, or if they're moving independently, meaning low correlation. And currently, implied correlation is also sitting at absolute minimum levels.
The crucial takeaway here comes from comparing these two different environments. Historically, major market tops and the actual beginnings of bear markets are characterized by two things happening at the exact same time. The VIX goes up, and implied correlation goes up. That means everything is extremely volatile and everything is falling at exactly the same time. But our current market reality, it features a low VIX and a low correlation. Because stocks are moving independently without that fear-driven volatility, we can definitively say this is not a market top.
And finally, Section 6, Strategy for the Future, and our shift to active management.
So what does a low VIX and low correlation actually mean for us? It tells us that we're in a stock picker's environment. We need a major shift from passive fear to active empowerment. Navigating this kind of sector rotation requires a really strategic data-backed approach. For the sectors that are currently surging and catching everyone's attention right now, like pharma, biotech, and insurance, the best strategy is patience. Wait for a natural correction to find a safe buying opportunity. Conversely, for the sectors that are currently correcting, like AI, chips, and semiconductors, you simply need to give them time to form a base and finish their corrective phase before stepping back in.
The grand takeaway from all of this is that the fundamental and technical uptrend of the market remains completely intact. But the era where you could just buy a passive index fund and watch the whole shebang rise in unison, yeah, that's hitting the pause button right now. To generate alpha in today's market, you absolutely need to rely on active stock selection. You have to follow the rotation.
The market isn't a bubble waiting to burst. It's a dynamic, rotating engine of opportunity, if you just know where to look. The data clearly proves the foundation is strong, but the leadership is shifting. So the only question left to ask yourself is, in an active market, are you ready to rotate? Thank you so much for joining today's Explainer, and we will absolutely see you next time as we continue to decode the metrics that matter.